Welcome back, everyone. Let's go ahead and get started on our next area of discussion. Last May, when we issued our standard setting agenda, we added a project on going concern to the short-term agenda. And since that time, we've been working with our board on what a new standard might include. This afternoon, we're joined by Nick Grillo and Andrew Cleve from the Office of the Chief Auditor, who work on our going concern project, and they're going to help guide our discussion today. So with that, Andrew, would you please go ahead and get us started?
Thank you, Barb, and good afternoon, everyone. As you are aware, the board added this project to consider the auditor's evaluation and reporting of a company's ability to continue as a going concern in response to changes in financial reporting, the auditing environment, and stakeholder needs. The auditor's going concern evaluation of issuers is required under federal securities law and is part of every audit conducted under PCAOB standards. Section 10A of the Securities Exchange Act of 1934 requires audits of issuers to include an evaluation of whether substantial doubt exists regarding a company's ability to continue as a going concern over the ensuing fiscal year. AU Section 341, the predecessor standard to the current AS 2415, was originally issued by the AICPA in 1988 and has not been substantially amended since then. Other audit standard setters and regulators have updated or are considering updating their standards regarding the auditor's evaluation of a company's ability to continue as a going concern. The objective of today's discussion is for members to discuss their views and experiences regarding topics relevant to the auditor's evaluation and reporting of a company's ability to continue as a going concern. We distributed a briefing paper discussing, at a high level, relevant background on several areas, including 1, the auditor's responsibilities under U.S. securities law and AS 2415, 2, relevant changes to the requirements of financial reporting frameworks, 3, input from previous PCAOB advisory group meetings, and 4, the activities of other regulators and standard setters. The briefing paper also includes questions related to members' views regarding 3 aspects of going concern for discussion, and we would like today's discussion to follow those topics, which are the current state of auditor going concern reporting, auditor procedures to evaluate going concern matters, and auditor reporting of going concern matters. In addition, we are interested in your views regarding relevant data sources for evaluating economic impact in academic research papers or external reports of which the board should be aware. Let's move on to our first topic, which is your views on the state of auditor going concern reporting. As described in the briefing paper, the auditor's going concern evaluation of issuers is required under federal securities law and AS 2415. Through our research and outreach, we understand that auditor responsibilities to evaluate a company's ability to continue as a going concern remain an area of interest for stakeholders. That outreach further indicates that some stakeholders, including some investors, believe that current auditor going concern reporting practices may not accomplish their intended purpose, to provide early warnings of companies' inability to continue to meet their obligations as they become due within 1 year. This brings us to our first series of questions. Given the related nature of these questions, I'd like to open up the floor for discussion on all of these questions at the same time. The questions are, 1, in general, how do stakeholders use the paragraph on going concern in the audit report to inform investment decisions? That is concurrent auditor reporting decision useful? 2, in general, what are your views on the use of information external to the company and or the use of emerging technologies as part of the auditor's evaluation of a company's ability to continue as a going concern? And 3, are there differences between how auditors and users of audit reports view auditor responsibilities regarding going concern? For example, is more transparency needed about the purpose of the auditor's work in relation to the evaluation of a company's ability to continue as a going concern? And do users of audit reports expect that going concern evaluation and reporting are designed to predict bankruptcy? We'll now open the floor to comments from members.
Christine Devine.
Thank you. First, I just wanted to say I'm supportive of a project in standard setting to consider changes to going concern. I will address one or two of the questions, but overall, I do think the revisions, it would be helpful if they consider alignment and consistency with US GAAP. And we spent quite a bit of time this morning clearly talking about the estimate standard and the specialist standards. And that's another area where we would want alignment with those standards and alignment with risk assessments. And if the auditor does properly apply the risk assessment standards and the estimates and the specialist standards, I think that's going to drive a positive outcome. And by modernizing this going concern standard, I think of it almost as a roadmap for auditors to use on how to apply these newer standards. We also talked about CAMs quite a bit, certainly this morning. And so I think it's helpful to look at how the CAMs might have focused on the significant judgments related to the going concern determinations. CAMs, of course, do allow us as auditors to call attention to auditing, how auditing going concern may be particularly challenging. And we also talked about the post-implementation review of CAMs, and I think feedback from the post-implementation review on that area in CAMs could be very helpful as well. There was one of the questions that we just had up on the slide that asked about use of external information and asked about technology as well. And as auditors, we do use some external information. For example, at Deloitte, we have a tool, and that takes all the publicly available data. The purpose of it is to look at identifying potential risks. We use trend analysis and we use regression analysis on that data. In emerging technologies, that's somewhat more limited usage, but I do think that use of emerging technologies could change and increase, again, with more innovation.
Thank you. Preeti?
I'm glad to see that going concern is on the agenda. I think it's ripe for reevaluation. So a few thoughts here. One is, in the materials we were given, there was some discussion about the FASB standard on going concern. And I think there's just some confusion because the FASB has this standard, and specifically because the PSLRA Act of 1995, I believe, is what establishes, in addition to the ones that were mentioned, the idea that the auditor has to do a going concern opinion. And so I just want to make sure that I remind the staff to kind of look back at that requirement as they revise it. And then secondly, in terms of what I think the users are looking for, I think users are looking for an emphasis on whether the financials are fairly presented, not so much the emphasis on GAAP in this specific context of going concern. So I think as we can give auditors more guidance on how to exercise that, and I have some ideas on that we'll probably come to in the later questions, but I think drawing the auditor's attention more to the fairly presents is going to get close some of that expectations gap between users and preparers. Thank you.
Thank you. Ron Edmonds?
Yeah, thank you. And I too am supportive of modernizing the standard. And I agree with Christine's comments that I think there is somewhat of a link between a CAM and possibly some of this. I mean, I think, this could certainly be, used as an early warning, obviously some issues with going concern. My only, I guess, caution is that I do think that there's a possible, or perception out there that anything, I mean, if there's a failure out there for whatever reason, that there should have been a going concern, opinion there. And I don't know if that's always the case, right? I mean, there are many situations where there are black swan type events that happen that I don't know that, management can foresee all of those, or, and they have to talk about, critical risks to their operations as well. And I think companies do a very good job in general of doing that. And obviously auditors are looking, for that and other type of things to make sure that there is a going concern. But it's very difficult to predict all of those type of events. And I just want to make sure that, people aren't using this as a catch-all for every type of a thing, because I don't think that there is a way that this is going to catch every going concern issue out there. Thank you.
John Lakomnik?
Yeah, thank you. I agree with what Ron and Christine said, and I would support a project on this, I want to point out two things, because the current going concern standard mushes a lot of things together. I know that's a very technical term. First off, going concern is unusual for an auditor because everything else is, as of a date certain. And this is asking someone to predict 12 months future. So where all the other audit tests are as of a date and ex post in effect, this is ex ante and continuing supposedly for a year. So it's a different mindset. The second thing, and when I said it was mushed together, there are two things that happen. One, the auditor has to have a reason to inquire of management whether or not it has reason need to mitigate something. So let me take it away from a U.S. context, so it's not point the finger. Carillion in the U.K. Auditor understood that they had a liquidity issue. Management says they have a rights offering offer coming up. And if the rights offering had gone off, perhaps Carillion would have gone bankrupt. But the rights offering didn't go off because the world changes, whether black swan or gray swan are foreseeable. And so it strikes me that in thinking about what information we as investors would like, I think separating those two things, one, we have a basis for concern, and no pun intended, about this entity being able to be a going concern. It's got a negative cash run rate that will exceed its available assets in the next 12 months. That is one judgment, and that is something that auditors are good at, right? That is what they have. The other is we therefore ask management for what it is doing to mitigate. And we either were convinced by management that it had both a plan to mitigate and that the likelihood of the plan succeeding was good, and therefore we have no going concern opinion. Or if either of those two tests fail, obviously there is a going concern opinion. And it strikes me that bifurcating that, where on some sort of new standard, the initial concern, the initial issues that give rise to having to question management ought to be made explicit somewhere, perhaps in a CAM, and then explain that, but we don't think there's an issue. We question management much the way they do in a CAM. So I just wanted to note those two things. Number one, that it's different in that it's ex ante as opposed to transactional as of a date. And number two, that by conflating both the initial finding and management's mitigation of that finding into one opinion, I think that sometimes things are missed that could be of information and value to investors.
Thank you. Steve Morrison?
Hey everyone. So in regards to this, I'm very supportive of the board picking this up. And going concern, I grew up in a medium-sized firm where going concern was a very common issue to deal with. And when I was on the auditing standards board, I was a part of the task force with SAS 132. So as I'm hearing all these things that are listening to what everybody talks about, and I think it was Christine Devine that said this about the kind of an auditing standard that, and I'm paraphrasing here, Christine, that kind of speaks to the financial reporting framework. And I think there's a lot that's in there about the estimates and so forth when we get to the auditing, but also ASC 275, the risks and uncertainty that and this is colloquially speaking, that these financial statements appropriately tell the story of what's out there. And I encourage the board to take a look at not just the ISA 570, but also SAS 132, because there's a lot, the board, the ASB spent a lot of time on the application guidance with a lot of, I don't want to call it prescriptive, but a lot of good food for thought in terms of this to help drive good auditor behavior, or good, I should say not behavior, but the that whole concept of obtaining that sufficient appropriate audit evidence that's there. But I do think that my personal view is that the standard should not be something in addition to what is already required in GAAP, but that it should align to the financial reporting framework. And that whole concept of what's already in 205-40, and then also in terms of the risks and uncertainties. So just because that maybe there is substantial doubt that's been raised and it's been alleviated, you also have your risks and uncertainties disclosures that kind of serve what I'm hearing people talk about in terms of that early warning. So that's what I had to add.
Thank you. Keisha Williams-Smith?
I will start with, of course, these are my personal views, but I did want to bring into the discussion some of the commentary from the Auditing Standards Committee of the AAA Auditing Section when we evaluate a discussion paper from the IAASB about fraud and going concern in the audit of financial statements, exploring the differences between public perceptions about the role of the auditor and the auditor's responsibilities in a financial statement audit. And this commentary was really in response to a call from the IAASB talking about the expectations gap, and to question number 3 about are there differences. We all agree probably there are differences in what users and readers of the financial statements might think about going concern and what the auditor's responsibilities are. So from my view, absolutely, I wholeheartedly concur with everyone that the PCAOB needs to move forward with this project. But I just wanted to highlight 2 things from this commentary that hopefully might be something that can be helpful for the discussion, because our committee suggested that increased transparency around the auditor's procedures around going concern might help with the understanding. Right now, it's not as understood as to what goes into that. And now that we have an environment around critical audit matters or additional disclosures being in the audit report, there might be some opportunity there to communicate that information, and then also possibly communicate this information to those charged with governance. So that was one thing for consideration, and also getting to the terminology that is used in going concern evaluations. That significant doubt, what does that really mean? Maybe putting some clarifying items around that. And then just really trying to, our main theme for going concern is just around increased transparency, because I do think there's a disconnect with the auditor's responsibility. How is that aligned with the FASB standards? So whatever the staff and the board can do to increase transparency around those processes for going concern will hopefully close that gap, and hopefully make sure that the auditor is always doing what they're responsible for in the context of the financial statement framework that they're auditing. Thank you so much.
Thank you, Keisha. Josh Jones?
Hey, thanks, Jessica. Yeah, just to add on to maybe Christine and Steve's comments a little bit. Obviously, we're very supportive of the PCAOB focusing on its standards related to going concern, and in particular the alignment of it with the accounting standards. Going to your second question with respect to views on information external to the company and the use of emerging tech, as Christine mentioned, I think auditors today use industry and analyst reports to really get a sense as to the stress a company may be under, the industry they may be under, and really to help inform us as to the company's place relative to its place in the marketplace, to help evaluate whether there are events and conditions, as well as to help challenge the company's views on their place relative to their peers. I think with emerging tech, it's interesting, and it's as Christine mentioned, it's evolving, but the use of data really can be helpful to provide additional insights into potential events and conditions. Auditors in many cases are able to get perhaps better information and deeper information around the loss of customers, the company's churn relative to its customers or vendors, to help amongst other things identify potential things that may not necessarily pop up through the use of other procedures that the auditor may be doing. So the use of data can really be a powerful tool to use when going through some of the procedures under the existing standards today.
Thank you. Melanie?
Thanks. So the question I really think I could speak to most is what, how do other stakeholders use the paragraph? So I could tell you as a regulator, we take a look at the filings we get. And when there's a going concern paragraph in the audits, we really do a much deeper dive than the dive we normally would do when we get filings and say, okay, so what are the consequences of this to a filing? What kind of disclosure has to be in the documents that go to investors? And in my office, we review franchise filings as well as securities filings, and really take a look at what do investors, what do potential franchisees need to know when they take a look at these filings about what the ongoing obligations would be from a franchisor or a franchisee, or from to a potential investor in a company. So as a regulator, we really look at these things because, we don't necessarily have the same access to information as all kinds of other people have into a company, and really, really rely on it. I don't know if everybody understands the degree to which we would take a look at this and use something like this to drive the kind of disclosure we expect to see going to investors about the financial circumstances of a company, and then come to the determination of how risky we potentially think an investment would be, especially if the company doesn't raise the kind of money they're expecting to raise, which is why we pretty much presume they are out there trying to raise more money because they've got a going concern comment in their financials. So it really is critically important. And, that's basically from the regulatory side, the point, we would want to make when we see something like this come up in somebody's audited financials.
Thank you. Brian Croto?
Yeah, thanks. So also very much welcome the dialogue here and very supportive of the PCAOB taking on this project. I would say that one of the things that I think it's important to be careful of is, and I think in your paper you've used early warning, the words early warning, and I think you've appropriately got it attached to then the words that follow relative to what substantial doubt is. But I think as some think of early warning, it's important to keep in mind that substantial doubt is sort of at a probable threshold, at least for the SASB standard. And I know that when the SASB not that many years ago landed on their new standard, it was with close coordination with the SEC. And I take the point as well that it's important to look back to what the SEC's requirements are for auditors in 10 Cap A of the 34 Act. There's a very specific obligation for the auditor to execute procedures and form an independent conclusion. And I think the FASB landed in close coordination with the SEC on probable, and that to some is more of a red flag than an early warning. So I think the use of those words, it's important to be careful. I also think the points around sort of where one would look as an investor to understand liquidity and risk. I mean, obviously, companies have disclosure requirements and obligations around risk factors in liquidity that are going to be much more robust and timely than the once-a-year audit report that's issued, and are at a much different kind of level of threshold and detail. So I think that's important to keep in mind. And then I'd also say, I think it surprises some at least to kind of look at the number of these reports that are issued each year. So like it surprised me years ago to look, and I went back to Audit Analytics to look in advance of this meeting. For instance, last year for 2021 reports, there were over 2,000 going concern opinions or reports with explanatory paragraphs issued, which is like 16% of public companies. And I think it was somewhere close to 15% in each of the preceding years. So there are a large number of these reports. It's then, how is the information used, and how does one think about the nature of that information as juxtaposed against all of the company's disclosures? I like the CAM comment too. I know we as a firm, if you look sort of in the earlier days of COVID, we have more than a handful of CAMs that we included in reports where there wasn't substantial doubt for a 12-month period, but perhaps still thought the going concern evaluation was important and a little more complex and subjective, such that we do have a good number of CAM disclosures in our reports that resulted from COVID implications. So I think good to look there too. And then maybe I just close with as I think about if there is incremental information that between companies reporting and our obligations as auditors today that investors would find helpful, I always come back to like, what would that incremental information be? You know, who should provide it? Where should it be provided? And what should the auditor's role be? And important to think about the coordination between the PCAOB, FASB, and SEC relative to management's obligations and company and auditor obligations, rather, as one thinks about incremental scope for the auditor. And that's not to suggest that you know, I am not supportive of incremental scope for auditors if that's you know, if investors would find that of value. But I think important to think about first what management's obligations ought to be and what the auditor's role ought to be. And the FASB should have an important seat at that table, I would think, as well, if there's incremental disclosures that would be useful. So wanted to offer those thoughts.
Thank you, Brian. Dane? We can come back. John Bendel?
Yes, thank you. Well, first, very supportive of a project to address or update going concern. It's been quite a while and a lot has changed. I'd like to come back to the point John made a little bit ago around transparency. And I think one thing, as I thought about this, that would be really important, I think, from a disclosure perspective and a transparency perspective, is that bifurcation. You know, if there is substantial doubt that the company will be able to continue as a going concern, but management has plans to address it that are credible, you know, thinking about the disclosure of that, I think right now, you know, there are the options not to disclose, but thinking about how that could interplay with CAM being something that would be almost required at that point, or, you know, laying it out in a more transparent fashion for investors, I think would be very beneficial. I think, you know, putting the two together and then maybe not disclosing in a way that is transparent, I think isn't valuable. Maybe that's an early warning. That might not be the right term to use, but I do think, you know, the transparency around that evaluation and the doubt and the plans that management has both being disclosed, even if the plans are credible, because things change. And as was pointed out earlier, circumstances can be pretty fluid when a company is in that situation. So that would be just a comment building on what John had said, and for more disclosure as you think about what you want to provide investors with the new potential standard. Thank you.
Thank you. Sarah?
Thank you. So I just wanted to share, and my views today are my own, but the Auditing Standards Board over the last year has conducted research related to going concern. It was led by Greg Jenkins, who is an ASB member and a professor at Auburn University. And we've done two prongs, actually three. One is an extensive review of academic research, but also a survey of financial statement users and preparers that had 134 responses, as well as detailed interviews with 25 users and preparers. We've looked at the work that the IAASB is doing in this space, both from a procedures perspective and the differences proposed for increased transparency in the auditor's report related to going concern. The surveys that we did, I will say, were structured in ways to avoid potential demand effects. So really trying to work through not guiding the answer, and also, as has been discussed earlier this morning, if you say, do you want more? Usually the answer is yes, but then you have to really get into, okay, what's decision useful information? And have shared the results of this in some of our open meetings, as well as with the IAASB, but would love to also provide this to the SEIAG if there's a mechanism to get this out to everyone that's appropriate. But what we found is that the financial statement users that we interviewed had a different variety of reactions to the information on going concern. One of the common themes was that more plain English type of language and better understanding of really what is management doing, what is the auditor doing, how do those interplay, would be incredibly useful in evaluating this information. We had difference, similar to some of the conversations this morning. 42% kind of skimmed the auditor's report and focused on non-standard language. 38% said, well, I don't spend a lot of time with the auditor's report as kind of a compliance activity, with 20% saying I look at it really closely. This is really important to me and I delve into it. So as we look at we have more findings that we can definitely broadly share with this. But some of that also, we got into kind of the question in number 3 of, is going concern a predictor of bankruptcy? And just really having more clarity as to what the going concern opinion is meant to mean. And as the standards are currently written, it's not necessarily meant to be a predictor of bankruptcy, but is there an expectation gap there? And how can that be understood? And then also, just as I kind of reflect on this morning and the KCAM versus CCAM conversation that continues, I think it's really important for this group to consider that the IAASB has an exposure draft coming out in June. And that exposure draft contains performance standard changes for the auditor, as well as auditor reporting differences. And so being really closely aligned and understanding what is being proposed globally and comparing that to what might be proposed in the PCAOB's project. And if I didn't say it, I do strongly support this project moving forward. Should have led with that, but really strongly support that. But I think that this is an opportunity for us to get in on the front end and make sure we truly understand if the standard setting diverges from either a performance perspective or a reporting perspective. What does that mean to investors? What does that mean to users? And is it intended? So if we use different words and we mean the same thing, does everybody understand the different words mean the same thing or not? So I think there's just lots of opportunities here to collaborate across all of the standard setters.
Thank you, Sarah. Dane, I think we lost you, but you look like you're back.
Yeah, all kinds of tech issues today. So, yeah, I mean, first off, investors do use the going concern disclosures, and I assure you that information gets digested almost instantaneously after it's released. I have filters on my machine that send me if those words are in a filing, I get an email telling me that it's come out, and I'm sure there's probably algorithmic traders who also just automatically put a trade in when one of those disclosures come. So that's the first thing. I pasted a section from AS 2415 in that I find that was in the document, but that I find problematic. The point is that auditors aren't required to design audit procedures to specifically focus on going concern as an issue. It's more just kind of like, well, if we go through all our other procedures and something through that procedure makes us come to the conclusion there's a going concern, then it's risen. I think that's problematic. I think there does need to be a standard procedure, where a company assesses going concern, thinks about it, has a critical discussion of it, the auditor, even in the planning stage, and actually, quite frankly, before they ever bid for a client. Because I think if you do have a procedure built specifically around the idea of focusing on audit, on going concern, I think you're going to probably get different audits. I think you're going to get better audits because it's really taking a critical eye to saying, okay, what can cripple a company? And, a lot of these audit firms have experts, sector experts, things like that. Part of that can be done at the national office level, saying, okay, in this industry, we've seen the following types of problems kind of occur at companies in this industry. This is what history tells us. These are, where frauds have happened, blow-ups have happened, these types of things. And then, the audit partner should sit down, read that, get some context from the experts, but then also then think about, contemplate, okay, for this particular company, what could go wrong? And that is kind of a bent towards critical thinking. And I think, at least a perception as an investor is that sometimes maybe audits become much more of a check the box exercise. We say, hey, we did this planning, we've said we're going to do X, Y activities, and we've gone through each one of these activities one by one. This is really saying take a critical eye and absorb information from the marketplace. Hey, if there's short reports out on a company, look at research reports from analysts. What is the market talking about when they're talking about this company? All those types of data puts should inform how the audit gets designed and what could go wrong and where a going concern issue is. So I'll stop there. Thanks.
Thank you, Dane. Robert Neckel?
Thank you. I didn't realize that. I agree with everybody. I think everybody said this is time. It's time for examining this. I've been around long enough to have been through some of the original discussions that are often referred to. One of the things I think that the profession should be thinking about, which means the board should be thinking about, is the fact that we've reduced this to a binary decision. Essentially, you give a going concern opinion or you don't. And whenever you have a binary decision, almost by definition, there's going to be errors, right? Because we're predicting the future. No one can predict the future. So I think I'd like to echo what two Johns who spoke already said, and I'm actually going to support Dane a little bit on this one, that I think, a well-informed investor actually knows what the financial statements are trying to tell us. And, maybe the going concern opinion brings that into focus more, but in a sense, the information's there. So I think the bigger issue personally is the fact that we have what we don't know. We can see the numbers. What we can't see is how did the auditor actually figure out that the risks are mitigated? I mean, that is the information I think that is missing from this equation. Now, I don't know how to do that. Maybe it is a CAM, maybe it's something else. But I'd also, again, emphasizing what Dane said, I would say, one of the questions I've asked myself over the last few years is this really a quality control problem? Are we, in fact, is the engagement level the right vantage point for trying to figure out which clients actually are in serious danger? Now, of course, there's engagement information that goes in that assessment. But it seems to me that with modern technology tools, data analytics, and things that we all now talk about, that some of this stuff could be much more efficiently and effectively done at a different vantage point, which I would, just for lack of a better term, would be at the audit firm level. So I would encourage the project team on this to think a little beyond what the current model looks like to see how, in fact, we can augment that model to try to get better information, not just better predictions. Improving the model predictions by 10% will help, but better information would be even more helpful, I think.
Thanks, Robert.
Thank you. That was a very informative discussion. Next, we would like to talk about auditor procedures. I see
Jeff.
Oh, his hand's down. Okay. Unless
You
Jeff
want,
wants.
you want to go, Jeff?
Go ahead. Oh,
You're
we can't hear you,
muted.
Jeff.
Thank you. Sorry for my up and down hand and my mute. I just wanted to say I support the project as well. Agree with a number of the comments made, including from Dane and Professor Chowdhury. I think there is a significant gap between what people think the going concern opinion means. I actually was part of a conversation with folks on Capitol Hill within the past week where they were asking about going concern in connection with the recent bank failures. And in the past, I've had an accountant describe to me the going concern opinion as, in effect, branding a dead horse with the word dead. So I think there is a gap there that could be improved or narrowed, and so I support the project. Two aspects of the memo that raise concerns with me, and some have already been mentioned, but one is with respect to CAMs, where the memo says staff research suggests that audit reports do not frequently include critical audit matter disclosures related to the auditor's going concern evaluation. That concerns me. And then in the next paragraph, the staff talks about emphasis of matters paragraph and says that could be used to communicate additional information regarding the auditor's going concern evaluation. However, we understand that auditors seldom use this option in practice. So I support the project, support improving the procedures to minimize the gap. And I think the project needs to also focus on disclosures, whether that be a CAM, forcing out CAMs in this area, or emphasis of matter paragraphs. Thank you.
Thank you for that, Jeff. So we're going to move on to the next section to talk about the auditor procedures to evaluate a company's ability to continue as a going concern. So the staff is considering the need to strengthen the performance requirements of AS 2415 related to the auditor's evaluation. Therefore, we're seeking members' views, in particular those of auditor members, on the current practices related to evaluating the company's going concern assessment. identifying conditions and events that indicate there could be substantial doubt, and when substantial doubt exists, evaluating the company's plans to alleviate the adverse effects of the conditions or events that raise substantial doubt. This brings us to our next set of questions. 4, and the numbers follow the numbers in the briefing paper. In your experience, what audit procedures are commonly performed to 1, identify conditions and events that indicate there could be substantial doubt about the company's ability to continue as a going concern, and 2, evaluate the company's going concern assessment? 5, in your experience, what factors are most relevant in determining if conditions and events indicate that there could be substantial doubt about a company's ability to continue as a going concern? 6, in your experience, what audit evidence is generally necessary to conclude that a company's plans alleviate the adverse effects of conditions and events that raise substantial doubt about the company's ability to continue as a going concern? And 7, how can the auditor's procedures be enhanced? Are there opportunities to improve the required audit procedures when evaluating the company's going concern assessment, or when evaluating the company's plans to alleviate the adverse effects of conditions and events that raise substantial doubt about the company's ability to continue as a going concern? And if so, what are those opportunities? So we'll open the floor to comments for these 4 questions.
Christine?
Thank you. So on the question on the audit procedures that are performed, and there was also a question on factors most relevant in determining if there's substantial doubt. I will say, although this might not sound satisfactory, but it is heavily dependent on the facts and circumstances of the entity. There is a wide range of scenarios clearly that exist in these circumstances. But our audit procedures do consider management assessment, and we also look at all the relevant information. We identify and we test the relevant internal controls, of course. One of the really critical pieces of evidence, as you might expect, is management cash flow forecasts. So those are critical, and that also includes looking at future compliance with debt covenants. And then the factors that are relevant that we look at, they could be external. So it could be COVID, for example. When that was going on, that was a very important factor. Or they can be specific to that particular entity. That's back to the facts and circumstances. So an example there would be a loss of a major customer. And as far as the audit evidence that we use in evaluating management's plan to alleviate conditions giving rise to substantial doubt, that also is an area of significant professional judgment. We do need to evaluate the probability of the plan being implemented, and then the probability of that plan having success.
Brian?
Yeah, so I won't repeat the things that Christine said, which I certainly agree with, but maybe just emphasizing a couple things and adding a couple thoughts. Certainly, again, agree with her commentary. I mean, as we look at it, it is going to be facts and circumstances, and certainly, depending on the operating characteristics, legal matters may be at play. But I think as you look at risk factors, they wouldn't be, or indicators, you wouldn't be surprised to hear things like negative cash flows or, adverse financial ratios, violation of those debt covenants, again, certain legal matters, loss of customers. I mean, all of those things may be indicators. The one point I wanted to maybe make incrementally, as you're exploring what auditors do today and what maybe auditors should do in the future relative to evaluating management's plans, the extent to which the plans are within management's control is an area probably to spend a little time on and thinking about what does that exactly mean, and how within their control must those plans be? Because I think that depending on how you view that, you could get different outcomes on whether you've overcome what otherwise would be substantial doubt sufficiently relative to the effect on your conclusion. So, the feasibility of the plans and the extent to which they're within management's controls, I think, are important concepts that, you probably through the inspections process or otherwise probably have insight into how it's thought of today, and whether there's, room for debate or discussion as to whether that should be changed in any way, or whether the way that's thought of today is sufficient is an area that I think could be worthy of some debate and dialogue.
Thank you, Brian. Preeti?
So I just wanted to chime in here. I tried to look for some research papers that would do a type 2 error analysis, which would be the case where you had a clean opinion given, but then, bankruptcy ensued in the next, 12 to 15 months. And I actually couldn't find one, which was disappointing. So I was going to start off by suggesting that the economic group consider that kind of analysis, doing that so that they could investigate these cases. I suspect that there might be situations where auditors are relying a lot on the recognized values in statements, like to do these types of ratio analyses or negative cash flow, the things Brian was just mentioning. But I think that needs to be expanded to consider off-balance sheet liabilities, hidden losses, like we saw in the case of SVB. Even significant estimates and assumptions where there could be a wide range of outcomes. And even if the auditor, agrees with management, falls in that range, right? When you're doing the going concern assessment, you kind of need to think of the high and the low, like the whole spectrum. So kind of expanding there and considering future commitments to payments. And really honing in on what's driving the business operations, what are the underlying characteristics, and are those at risk? So I think that pointing the auditor to these kinds of things will get the auditor perhaps more focused on the fairly presents aspect of the opinion, which I think ties to the going concern. And I think the research on this, on the type 2 errors, could help and be super informative about other cases that maybe I didn't think of or mention. Thank you.
Thank you. Sarah?
Thank you. And I'll do my best to not repeat what Christine and Brian have outlined so well. But I think, when we talk about, and this goes back to, I think, Dane's comments on, is it action steps that you're doing specifically for going concern, or how does it actually work in the current audit where you're gathering information from what you've seen in the audit? And I think that what we're doing today is gathering information from all of our areas of testing. So as Brian mentioned, in debt and equity, you're looking at debt covenants, you're looking at cash flows. When we're doing testing of operations, revenues and expenses, we're looking at that and then comparing that to what we see in inventory reserves. So are we seeing that there's demand for the product? Are we seeing that there's turnover at good rates? Also comparing that to, if a client says we have net loss, carry forwards or carry backs, how does that compare and contrast with what we're seeing from the different assumptions for impairment analyses? How does it all fit together? So a lot of what we're doing when we're pulling the going concern information together is looking across the various audit procedures and understanding the interplay, and then also looking at board minutes, the legal letters that we get back, industry trade journals, what's going on in the market and the economy that's impacting the client in their operations going forward. And then just adding a few things when we're evaluating management assessment. One of the big things is how good and detailed is it? Is this a quick kind of back of the napkin that management did because they don't really think it's a big issue that they need to worry about, or is it a full plan? Has management's plan been taken to their board, to their audit committee? What level of approval does it have? How much depth is in there? And then how do some of the actions in the plan, Brian mentioned, are they fully under the control of management? That's a really important, right? Can management execute on these? But then what other impacts do they have? Maybe a plan would be to sell some assets. Okay, well, what are you going to do for operations then? Is it actually a sale? Is it a sales leaseback? What's the current environment? What, have you actually talked to a bank or a lender yet? Or are you thinking about talking to a lender? And just really evaluating where that plan maturity is for us to be able to understand, okay, is this a plan that has a probability of success or is going, does mitigate the going concern items? I think that's what I'm hearing a lot of the question is in that gray space, right? That's where we spend the hardest time auditing is if you get into that, there are some indicators. Management has a plan that is well vetted, has a lot of detail. They've started to take steps to execute that plan and evaluating through that. So I think that just wanted to add a little more potential color to some of the things auditors are doing today. Thank you.
Thank you, Sarah. Keisha?
I did want to just add a comment about the availability of research around what we call the accuracy of going concern opinions, and did want to highlight that the Foundation for Auditing Research did a review of auditor reporting on going concern uncertainty and looked at a number of things, including the accuracy of going concern opinions. And one thing that did come out of that synthesis of about 149 academic studies around going concern was really about what is a decision aid, because we're talking about audit procedures and those statistical failure prediction models. So things we've heard of like Altman Z and all that good stuff. Those seem to be a better predictor of, bankruptcy. We know that GCOs are not intended to predict bankruptcy, but, using those decision aids. And I think I heard earlier in the earlier processes, we know that auditors, and they've shared what they are doing, but one thing is to maybe have something a little bit more pointed and earlier in the process. Because when I switch off and put on my instructor faculty hat, when we teach about going concern assessments, usually we're talking about in the wrapping up kind of phase of the audit. So maybe making sure that those procedures around this, clearly they're throughout the audit, but maybe making sure there's some highlight and some focus earlier in the audit approach, and maybe using some of these other predictive models, especially with the advent of the technology and analytic tools, can be used probably easier than it could be some years ago to help as other decision aids in the auditor's implementation. And then just to the staff, if you're interested in the executive summary from the Foundation for Auditing Research, I can absolutely make sure that that is made available to you. Thanks so much.
Thanks, Keisha. Kara, I saw your hand go up.
Hi, this was a follow-up to Keisha a little bit, but the FRC in the United Kingdom has a rule about a viability report, which states the board should report on whether it has a reasonable expectation that the company will be able to continue an operation and meet its liabilities as they fall due over the period of their assessment. And they make it clear that reasonable expectations does not mean certainty. Is that something, and auditors then review and comment on this disclosure in the reports. Is that something that would be helpful in the United States? I just wanted to hear what, people in the SEIAG might think about that. Thanks.
John McComnick?
Actually, Keisha's was also a perfect lead into what I wanted to mention. Should you decide that there are extra procedures needed, one of the things that I find is that we all talk to each other. We all stay within the auditing and the academic communities. There are other people who look at all these issues from a different point of view, and I'm not going to go into all the tests we do, but one thing I am familiar with is distressed debt investing. And it strikes me that if you are going to explore other analytical techniques, to use Keisha's phrase, you might well consult some of the better known distressed debt investors, because that's what they do and I did at one point. And it gives you a different viewpoint on the same set of financial information, but you also sometimes go out and use other information. So I will just leave it there, but just if you're going to do it, you might want to consult with those types of investors for some suggestions.
Thank you, John. Jennifer Jo?
Yeah, in thinking about the standards, I would encourage, the staff and the board to think more in terms of a principles-based approach when they're doing this, rather than recommendations for audit procedures. And my concern is that in general, in audit areas, when the standards give specific items and procedures should be done, auditors tend to adopt a checklist approach rather than a holistic view of what is the true problem that we're trying to get at. And so if auditors are encouraged to think about the approach in terms of what we're really concerned about is viability, and how best can I assess viability in my client-specific circumstances. The problems when we tell auditors about general things to do, they tend to not tailor it to their client-specific circumstances. And so that's one item that I'd like to the staff to consider. Thank you.
Thank you, Jennifer. Lynn?
With respect to the procedures, I found that they vary dramatically by audits. Some of that is caused by the circumstances. Part of it is caused by the literature that talks about the fact that if the auditor has a concern about going concern, that then the auditor must undertake certain procedures. But it also, as I recall, talks about if an auditor doesn't have a concern raised with respect to going concern, then it doesn't have to apply those procedures. And I've actually seen audit engagements where as they're signing off on the audit program for going concern, they say, well, nothing, they have a short sentence that says nothing raised a concern, and therefore we don't have to do these procedures. And in some of those instances, the companies had liquidity and other solvency type problems that clearly should have had procedures applied. And that kind of get out of jail type language that's in the standard now really needs to be deleted and turned into a positive. You need to do these tests and procedures, because all too often the procedures we heard the audit people on the call talk about are only done in certain cases, but not in all. And so I think that's one thing with respect to procedures. I think the point Kara made with respect to the type of report that they talk about in the UK, it's very consistent with what we have in the state statutes here in the US with respect to what's deemed to be solvency or not solvency, where you have to look at the ability of the company to pay its liabilities in the normal course of business. And I think that type of language would be much better than this 12-month hard set that's currently in the literature. At the time the standard was written and the 12 months was incorporated in, it was to limit the liability of auditors to just a 12-month time period. And that's what their litigation counsel pushed for. But I think realistically, the UK type standard is a much better standard, and we need to get rid of the 12 months, especially when there's significant amount of debt that may not be coming due in the next 12 months, but 15 months out, it will be coming due, and raises the question, how are you ever going to pay that? So I think the 12 months, Kara's point on solvency is very well taken. And the language with respect to when you do or not have to do all those procedures that people are talking about, which are good procedures to do, but the fact we don't always get those, and we get no transparency as investors to the fact as to when those procedures are or are not applied. In fact, this very well probably should be in the CAM thing saying, talking about what you did or did not do with respect to going concern. So.
Thank you, Lynn. Dane?
Sure, a couple things. First, I agree with Lynn about removing the whole 12-month issue. I mean, hey, we can look to financial statements. We get these schedules where companies are saying what their payments are, their contractual payments are out for several years. So if there's concern in year 2, year 3, year 4, that's still relevant and it should come in. I think to Kara's point about the UK, yeah, I mean, I think having those types of documents out there, it's something, again, where, removing this from a check the box exercise and making it an explicit part of the process. We're saying we are going to assess going concern, even for companies where maybe it's a remote issue, but we're going to make it a standard part of the process, and we're going to have to report on it. Sometimes when people have something where they have to, have some paper to file, then that makes it more precedent. The other issue is, a lot of folks have talked about technology and using technology to make things better. I love technology. We do all kinds of things with technology, but the one thing I'll say is that when we're talking about financial statements, technology is mostly just going to be helpful to help you kind of look at historical information. And, from a market perspective, a company's outcome is both its historical and its forward-looking. So, it really kind of speaks to what I really think is important, more so than like, oh, we're going to apply technology and, help us find the issue. It's more important to have imagination, looking at this company and saying, what could go wrong? What does history tell me about other failures in this company? It's critical thinking, and that's not machine-based. That's critical thinking. I think, Jennifer Jo, brought up the whole check the box, and I think that is a concern, especially if we're going to say, hey, we're going to go and we're going to tick every line and we're going to look at how the balance sheet relates to the income statement and we're going to check the box and see the relationships hold. But the problem is how those things move and how they are 6 months from now and a year from now. And those types of procedures aren't going to do that. You're going to have some imagination. You're going to have to bring in market information and think about how things could change. So I'll stop there.
Thank you, Dane. John Bendel?
Yes, thank you. I'd like to pick up on a point that Brian made earlier that I think was a really good one and something I thought about when I read question 6 about the audit evidence necessary to conclude. What does the auditor need? And the point was the staff or the PCAOB, if they take on this project, should think a lot about what's in control of management or the company. I think that would be a really, really good area to focus on when you think about, hey, what evidence is needed for the auditor? How much in control of the plan is management? There's a continuum there. And you could even think about that in the context of, okay, what would that mean for disclosure? Maybe what the auditor would need to disclose or how that would be informing the disclosure. So I just think there's some interplays with that. If the control is in management versus something in the middle or something on the other end, and how those play a part. I think making the standard operational will be important, and for the firms, and I think that is a really critical aspect of how this could play out from an operational perspective, and then even thinking about how that could be disclosed and how that could be incorporated into the disclosure, whether it's the CAM or the explanatory paragraph or something along those lines. Thank you.
Thank you, John. Steve Morrison?
So I was listening to what Lynn Turner said, and I thought he brought up a lot of interesting concerns. And I know what he's talking about when he says that in an audit program, it says, hey, are there any conditions or events which raise substantial doubt? And an auditor just writes none noted. That may not be appropriate in all situations. And I would say I agree with that concept. But it kind of gets to this whole concept of risk assessment. Is there a reasonable possibility of a material misstatement in these financial statements? That whole concept of just saying none noted, you could apply that to cash through other expenses. It's something that the auditor has to obtain sufficient appropriate audit evidence. And if there are conditions or events, if the auditor has done the appropriate amount of skepticism and kind of taken all the relevant information in to say, hey, wait, there are conditions or events, and appropriately challenge management's estimates or what management's assertion is. If management says there are no conditions or events, I'm going to apply my skepticism to that. So that, and then when we get to the, and I caution about the 12 months, and I think it's a valid point when you say it's like, well, going concern only goes out 12 months and the debt is due, say, in 15 months and so forth. But in my mind, that's kind of where the importance of management's disclosures and the risks and uncertainties, you drag it out a few months and say, hey, by the way, that although this is outside the 1 year assessment period, we do have a significant amount of debt that's due, and figuratively tell that story so the user can understand that. And I do get what everybody's saying about, hey, having more clarity into what auditors do and do not do regarding going concern. But I caution against the flip of that, the unintended consequence of saying, hey, we did all this work on going concern, or we didn't, and so forth. Are we potentially misleading readers? Are we people kind of serving as almost some type of assurance that the entity is going to be able to make it through that particular next year? So although I do appreciate the transparency, and if you take a look at an ISA report with 570, it does have some wording that's in the audit report itself, and the AICPA has somewhat similar wording as well. But at the same time, the more you talk about it, the more it makes it seem like the auditor is kind of implicitly providing some assurance. And then I'm all for information. I'm all for readers being able to get the information that they need to make the decision, useful information. But keep in mind that, as we all saw with some recent events, how hard it is sometimes to look out just a few weeks. And we're talking about a 1 year period. And now you're saying, oh, we're going to drag it out even more. Well, it becomes very, very, it's not just saying that it's hard, but it's also, there's a lot of uncertainty that goes there. You can make the assessment period for going concern 10 years. Well, guess what? Brian mentioned 2,000 financial statements that had going concern opinions. I would eventually, we would have quite significant more, and going concern really wouldn't have the strong effect that it might have in some circles now. So there's a balance to be struck with this, and when we're particularly talking about this forward-looking type information. So as much as we all want, I think, more information and more clarity, there is an unintended consequence if we're overly prescriptive and that we're overly verbose in terms of the wording that's used on there. It might unintentionally mislead the users that are out there. That's what I had to add.
Thank you, Steve. Brian?
Thanks. And I was actually initially going to respond to Kara's questions, and then there have been some interesting comments that Lynn and John and now Steve just made, which I think are all. I think this is a great dialogue. In response to Kara's question, and maybe focusing for a moment more on the IWSB proposal that just came out, like some of the things, and we're still looking at it. It was just exposed, but some of the language, you might have similar or the same language in a report. There's illustrative reports, even if there's not going concern issues, and so I like the discussion that we're having now about thinking about obviously the specific facts and circumstances and describing what the auditor did. It could have some benefits, but Steve lays out some really important risks to consider with that some may misunderstand what that's intended to communicate, such that they take some undue comfort from it. And you go back to this, there are 365 days in a year, and the auditor's report is issued on one day of that year, and the timing of that may not be great relative to understanding particular events at the company versus the company's ongoing disclosure requirements. And so I think all those things need to be thought about carefully in thinking about what incremental role auditors could have, which goes back to earlier comments I made around CAMs that I think apply here, of, again, one where it's good to have FASB and SEC at the table relative to company disclosure, the auditor's role relative to that disclosure. I think those are important things to think about together as one thinks about what more auditors can do and what might be beneficial for auditors to do in this space. But it's an area that, I think this is a very rich dialogue, and I think it's a very good dialogue to have, to push ourselves think about what else could we do where we can be adding some incremental value that's useful for investors in the context of going concern.
Thank you, Brian. Tony, I saw your hand go up.
Yeah, thank you, Jessica. Yeah, I think we sufficiently, well, maybe haven't sufficiently discussed the aspect of defining substantial doubt. I know that's one of the things I have thought about, over and considering, going concern. And again, I know it's difficult to quantify. But I just wanted to, would Prepare have the same definition of substantial doubt as an investor and as an auditor? Just wanted to get some thoughts on that.
Lynn Turner, I think you were next. I don't. Okay, Lynn's hand went down. Sandy?
Actually, I had it on mute. I'm sorry.
Oh, sorry. Go ahead, Lynn.
And Tony, to your point about the substantial doubt, the issue of how to define substantial doubt, has been around for 50 years and no one's ever really done it any real justice. Some of the firms will say it's probable, and that means it's a 75%. I seen one of the big four firms manual actually quantifies it at 75%, although you'll never see the FASB agree to that or say that's the number. But this was the point that the investor advisory group made back when it was looking at this issue. I'm going to say back whenever, 10 years ago, 9-10 years ago. And the CFA Institute at the time did a marvelous survey that you definitely should obtain and look at. And rather than try to make it a black and white line that's still not so black and white because it's subject to judgment, it is the CFA Institute, the people who are actually using the financial statements said, let's do this in increments. We want some earlier disclosures. And then as issues start to pop up on the horizon, and then enhance and increase that level if those conditions and situations continue and trend in a negative fashion till you get to the point that you think they very well may not make it, at which time you get to the going concern disclosures by the FASB and then appropriate disclosures by the auditing standards. When the FASB did that project, the chairman of the FASB at the time and the auditing chief auditor did not want to redo the standard because they felt that the FASB standard actually didn't meet what investors said they were looking for and rejected that notion and didn't ever put the project on the agenda, which is why it's not been on the agenda till this point in time. At the same time, investors didn't embrace, as that CFA Institute survey shows, what the FASB did. So the notion of putting something on the table and just doing it to make it consistent with the FASB would be sending a clear message to investors as far as they're relying on the PCAOB. So I think you got to go back as you go through this project, take a look at that survey and take a look at what investors were asking for, because that's your charge. Your charge is to protect the investors and the accuracy of the financial statements. I think Preeti said it perhaps exceptionally well when she said the focus needs to be on whether the financial statements present fairly. And the courts have defined that term. And the courts have noted that just because you comply with the FASB doesn't mean you've got fairly presented financial statements. And so I think you got to consider that carefully in this whole context. So, you know, that would be my response to that. And there's a real issue out there about the quality of the FASB standard, which quite frankly probably isn't very good.
Thank you, Lynn.
Thank you, Lynn. We're going to take Sandy, John White, and then Jennifer Burns, and they'll go to our last set of questions. Sandy?
Well, I was feeling lucky that I was going to come after Tony, but I appreciate Lynn's calling out CFA Institute's work on this. You know, as I heard the conversation, I went back to the back pages of the standard because the question to me is, are auditors qualified for this, right? Do they need specialists to help them? And what does the standard actually say about this? Yeah. And it gets to Tony's comment about, well, do investors and auditors have a different perspective on this? Yeah. I think you're saying, do they bring an investor mindset to it? And I think Lynn's comment with respect to, you know, we're looking for warnings of risk, not the cliff is right here, right? Is what we're looking for. And I think, you know, some of the situation over the last year with the impact of interest rates on interest rate risk is an example of, you know, even disclosures within the financial statements that we needed to educate both investors and the auditors about those asset liability mismatches, right? That would have made it more obvious with respect to that there was emerging interest rate risk and how did that get incorporated into the liquidity risk. But when I look at the actual standard, a lot of the language seems to me to be heavily internally focused, analytical procedures, review of subsequent events. The consideration of conditions and events does go to possible future events, negative trends, but a lot of those are ratios that are internal and possible financial difficulties, and it talks about internal matters. And there's one bullet on external matters that have occurred, and it focuses on legal proceedings, legislation, similar matters, loss of franchise license, loss of a principal customer, et cetera, et cetera. It doesn't necessarily consider, you know, market conditions, right? I mean, having been an audit partner and having been internal to a controller, there's a lot of conversations that the auditors aren't a part of, right? And management has vastly more information about how the business behaves relative to the economic conditions that exist than do the auditors. And the auditors generally don't exist. They don't participate in those conversations, right? So they're sort of starting at a stop when it comes to understanding how those external factors are incorporated. And to what degree does it require, because we see short sellers identifying, there was a lot of conversation at the fraud panel, which was very good at the IAG, about short sellers identifying fraud and short sellers identifying problematic conditions for a company in advance. So does the standard, my point is, does the standard need to say, you need to use specialists to ensure that you effectively have an understanding of the marketplace in which the company operates, right? And have you looked at what the investment community has said about the company? How has that actually been brought into play? I don't see that the standard in one sentence, I don't think does that external perspective justice. Is when I listen to all of this conversation, are auditors qualified to do this? Do they need to bring in experts to do this? And do they need to have an outside in rather than an inside out perspective?
Thank you, Sandy. John White?
Yeah, let me follow a little bit on Tony's question and Lynn's analysis here. It certainly is a question that comes to lawyers all the time under the FASB 450-20 probable standard. That I feel like I'm consulted probably twice a week on that with different companies because it's there all the time. I guess first of all, there's a tremendous amount of experience and knowledge on that topic or on that standard and that term at the accounting firms. And Lynn described it quite well. I mean, it is 75 to 80%, and you get those numbers from any of the big four at least. I mean, everybody understands, I think, from the experience of applying that. And just as an aside, don't think, oh, well, if it's 74%, then you're clear, because I think you say 75 to 80, but anytime you're above, like, I don't know, 60%, you really start worrying about it. So it really is a somewhat lower number. But I mean, with the amount of knowledge out there and experience, I guess I would at least suggest that it would be a very useful standard, because it is somewhat principles based, I think, because anytime you get close to the 75 to 80, you really start worrying about it. But I guess, Lynn, I actually think that maybe it does work, and I kind of like the idea of aligning the two standards, the audit and the accounting standard. I guess I'd also just throw in, I guess I heard earlier, I think it was you, Brian, that said it, but somebody said 15% are the number of going concern opinions we're seeing now. Are we really, that seems like a fairly high, well, I don't know, do we want a percentage higher than 15%? I mean, obviously we don't have 15% of the public companies going into bankruptcy or reporting significant financial problems each year. At least I don't think so. So I'm not sure we're trying to get some ultimate result that's higher than that. Anyway, maybe you analyze it differently and say, no, I don't want a numerical number. But if you do use probable, I think from the experience with the audit firms, you're getting a number at this point.
Thank you, John. Tony, did you have something else?
No, I'm good. But I appreciate the different, slightly different perspective. But I see Lynn has his hand up.
Lynn. I think you're muted.
Yeah, I am. Sorry about that. In a perfect world, we'd want, a pretty high correlation between the number of going concern reports and then companies that in, a reasonable foreseeable future went out of business. And we certainly saw a significant rise in recent years because of the economic times we're in. And we always see that when we go into down economic times. So while the 15% probably seems high to all of us, including myself, I think it's more a matter of it's the economic times we're in with the pandemic, which was a once in a lifetime thing. So to see 15% in the instance of a once in a lifetime type event, that doesn't disturb me at all. But what I really want to see, and what I hear from investors, and what's in the CFA Institute survey, which you apparently reject, is that the investors want earlier warning. It's not tell us when we're going to go over the cliff. Tell us when. Investors want to hear, when are we starting to head towards the cliff? And then tell us as we proceed if we're getting closer and closer to the cliff. We don't want to be in the car with Thelma and Louise, and right now that's where we're at. These going concern reports are going over the cliff with Thelma and Louise. So tell us at the beginning that we're starting to head in that direction. And that's not a going concern report. That's certainly something in terms of disclosure in the footnotes from management. It's also something in terms of disclosure in the CAMs that the auditor has identified it and then taken selective steps as they disclose with respect to what they're doing. And then finally, if we get that close to the ledge, then yeah, tell us that you're in the car with them and Louise. So if possible, we can bail, you know? That's what we're talking about here. That's the system that we need to create. We don't have that system today at either the FASB, because they rejected what investors asked for, or at the PCAOB in a standard that was written by the profession 40 years ago, you know, when they started doing this. So it's not one or the other. It's how do we create a system that in accordance with SOX serves investors? And that's, we just don't have that. And that's what our objective should be. And then when this standard is written, this standard needs to have a statement right up front in one of the first few paragraphs that says, here is what the objective of this standard is and what we hope to achieve, so that that sets forth guidance on a broad basis as to what the audit needs to achieve. And unfortunately, everyone wants principle-based standard, not everyone. Some people like principle-based standards, but then they hate you to write that objective up front, which is unfortunate because that tells you, yeah, we want a loosey-goosey standard that can't be enforced. Thank you.
Thank you, Lynn. Andrew?
Yeah, thank you, everyone. Again, very informative discussion there. Lastly, and we're running a little bit over time here, which is, you know, I guess it's a positive thing. We're having lots of discussion. Lastly, we'd like to just get members' views on auditor reporting of going concern matters, which we've obviously already been discussing to a fair extent. So as mentioned earlier, other regulators and standard setters have made or are considering making changes to their requirements regarding the auditor's evaluation of and reporting on matters related to going concern. Previous discussions with advisory groups, PCAOB advisory groups, have indicated an interest from some stakeholders for the auditor's report to be more transparent and to provide additional information about the audit engagement, about the auditor's evaluation of going concern. We're interested in your perspectives on the content of the auditor's current going concern paragraph, and if enhancements are needed, what changes are appropriate to make auditor going concern reporting more meaningful. So this is our last series of questions, which, given our short time remaining, we're looking for essentially incremental comments on, because we've had a lot of great comments on reporting already. Question 8 is the content of the auditor's going concern paragraph useful to investors? Can their auditors' reporting of going concern matters be enhanced to be more useful to investors, and if so, how? Would additional information about close call situations, quote unquote, beyond those that might already be contained in some critical audit matters be useful to investors? And then lastly, Staff Audit Practice Alert 13 states that management's going concern evaluation under the applicable financial reporting framework is not conclusive to the auditor's evaluation under AS 2415. What challenges do auditors have under today's model in reporting close call situations? So we'll now open the floor to the comments on these last 3 questions.
Thank you, Andrew. Sue Cosper?
Thanks. I just wanted to comment. One of the other things that the FASB standard does is provide incremental disclosure. And even in those circumstances where substantial doubt has been identified, as well as management plans may have alleviated it. And I do think, and there's been some reference throughout the conversation today about some alignment to the auditing standards in that regard. And I do think that would be helpful, and that would be helpful for investors as well. And while I have to stand, if you will, I think the only other comment that I wanted to make is from a consistency perspective, when the board at the time was developing the threshold for substantial doubt, what we found in practice is that the standard that was applied was all over the mark. It was really, really high. In some instances it was low, but there certainly was an inconsistency in the way that was evaluated. So I don't think that inconsistency in the application is useful for investors either.
Thank you, Sue. Jennifer Burns?
Thanks, Jessica. I've really enjoyed the discussion here on this topic and really want to encourage the PCAOB to take a data-driven approach in terms of updating their standard, recognizing that, since the time that the standard that the PCAOB has in place, since it was written, both the IAASB and the ASB as well as FASB have evolved. So certainly want to take that into account as well. But we've heard about various studies that have been done. So you've got the ASB study that's taken place. You've got the academic synthesis study that Keisha has mentioned, which is great. Obviously, you have all the data from your inspections, which certainly we should be taking into account. And then Brian also mentioned, the audit analytics data. They studied over 21 years of going concern reports. And so understanding the impact of what has happened in the past will help us figure out how to make the standard better for tomorrow. And so really want to emphasize that point. To this specific question about close calls, the ASB study specifically asked about this point, and there was no consensus about whether close calls should be either disclosed by management or the auditor, or talked about by management or the auditor. Certainly, it's probably better to be in the purview of management. I think it's management's disclosures that we're wanting to provide that roadmap of what's happening in terms of the company and whether it's approaching the cliff or not. So wanted to mention that point about the ASB study. The other point I wanted to emphasize is that term going concern itself, we find is very confusing to pretty much everybody, sophisticated users as well as non-sophisticated users. That term has the word concern in it, which, intuitively is hard to understand. So that's something that the ASB is considering, and I would encourage the PCAOB to think about that as well. Thanks.
Thanks, Jennifer. Okay, so we don't have any more. Oh, John White snuck in there.
I did. Are there any statistics out there or studies about whether where there is a divergence between the auditing standard and the accounting standard in terms of actually, a company having a difference in the two when they report them? Because it just strikes me that as I see the process, at the end of the day, the auditors and the company are going to converge, because they're not going to want, the company's not going to want to be in a different place at the end of the day, and have their auditor say there's a concern and they don't. So I'm just curious if there's any information out there about
John, I'll say that the staff have studied that for a number of years. I'm not really at liberty to provide any details on our analysis, but that would be something we would touch on in a proposing release.
Okay, sorry to sneak in, but okay, thank you.
That's okay. You're more than welcome. I don't think there are any other hands up. If it's okay, if we could maybe take a 10-minute break before we come back. I have 2:24. If we could be back at 2:34, if that's all right, because we do have one more session to get through. And thank you, everyone, for the great commentary on that session. And please remember to mute. Thank you. Welcome back, everyone. Our last session is a discussion of Substantive Analytical Procedures project, which is on our midterm standard setting agenda. Today, we're joined by Donna Silknitter and Sarah Madras of the Office of the Chief Auditor, who are going to guide our discussion today. So Sarah and Donna, please go ahead.
Thank you, Barb. Good afternoon, everyone. And as Barb said, I'm Donna Silknitter, being joined by Sarah Madras. And we're part of the team on this midterm agenda project, which is comprised of other OCA professionals, as well as colleagues in the Office of Economic and Risk Analysis. Brian, you get perfect. You will see today we have 4 topics that we would like to cover, and we'll spend about 15 minutes on each topic. Before we get into our first topic, I would like to briefly introduce our substantive analytical procedures discussion. For purposes of our discussion today, Sarah and I will both refer to substantive analytical procedures, also as SAPs. PCAOB standards require the auditor to design and perform substantive audit procedures that address the assessed risk of material misstatement for each relevant assertion of each significant account and disclosure. Substantive audit procedures include test of details and SAPs. SAPs involve the auditor developing an expectation of what recorded amounts are likely to be based on plausible and predictable relationships between financial and non-financial data. SAPs also involve the auditor comparing the expectation to recorded amounts or ratios derived from recorded amounts, investigating differences, and performing additional procedures if necessary. SAPs range from simple comparisons to complex analyses involving many relationships and elements of data. AS 2305, Substantive Analytical Procedures, is an interim standard that establishes the requirements regarding the use of SAPs in an audit. And since the standard was written, the board issued certain fundamental auditing standards in 2010, addressing areas of auditors' responsibilities related to identifying, assessing, and responding to risks of material misstatement to the financial statements. And there have been advancements in both the use of technology-based tools by auditors to access and analyze data and the availability of information, which may affect how and to what extent auditors use SAPs to respond to assessed risks. We are interested in hearing your views and experiences regarding topics relating to the auditor's use of SAPs. And to help facilitate the discussion, we distributed the briefing paper discussing several topics as shown here. 1, use of SAPs in an audit to obtain audit evidence. SAPs as part of the audit response to assess significant risks, including fraud risk. Sources of information used in developing the auditor's expectation and the precision of the auditor's expectation, and changes as a result of advancements in technology. We believe that this discussion will fit well with our interest in whether SEIAG members are aware of academic research papers, external reports, or other information sources for evaluating potential economic impacts of modifying PCAOB standards relating to SAPs, or providing additional perspectives on this topic that should be taken into consideration. And with that brief overview, I'm going to hand it over to Sarah to discuss our first topic. Sarah?
Thank you, Donna. Hello, everyone. Under PCAOB standards, auditors are permitted to, but not required to perform SAPs as part of a financial statement audit. As Donna mentioned, an auditor may perform a SAP, test of details, or a combination of both to respond to the risk identified. Generally, more persuasive evidence is obtained from a SAP when a relationship is more predictable. Relationships involving income statement accounts tend to be more predictable than relationships involving balance sheet accounts, since income statement accounts represent transactions over a period of time. With that background, let's dive into the questions. In your experience, what type of accounts and relevant assertions are SAPs used for as part of the auditor's response to an assessed risk of material misstatement? Are the SAPs used alone or in combination with test of details? Also, do preparers use analytical procedures, including developing an expectation? And if so, for which accounts and for what purpose? And with that, I open the floor for comments.
Christine?
Thank you. So again, for this project, I'm also very supportive of it. And I will say, when used right, substantive analytical, or SAPs, I should say, are a powerful procedure. They do allow us to gather, I think, really appropriate auditive evidence that helps us in our response to risk of material misstatement. And they do give us meaningful insight. And they, I think, are really good tools that can be used. As far as how we commonly use them, I would say it's with the income statement accounts where there's a high volume of transactions. That would be one area. And there was some questions about whether or not we frequently use them alone to address significant risks. And I think there's some guidance that I'd take a look at there that deals with how it's unlikely that the audit evidence obtained alone would be sufficient. So that's just something to take a look at too.
Thank you, Christine. I see no other hands at the moment.
Okay, if there are no other comments, we will move to our next set of questions. As part of identifying and assessing risk of material misstatement, the auditor is required to determine whether any of the identified and assessed risks of material misstatement are significant risks, which are risks that require special audit consideration because of the nature of the risk and the likelihood and magnitude of a potential misstatement. For significant risks, it is unlikely that audit evidence obtained from a SAP alone will be sufficient, and auditors are required to perform tests of details that are specifically responsive to the risk. So our questions to the group are, in your experience, what are examples of SAPs used as part of the audit response to significant risk specifically, including fraud risks? Also, could SAPs ever be as effective or even more effective than tested details in responding to a significant risk, including a fraud risk? And when would this be the case? So with that, we open it to comments.
Brian Croto.
Yeah, so I didn't want to chime in on the last one just because, other examples in case it's helpful. I mean, certainly to Christine's point, things like depreciation expense or salary expense, cost of sales, I mean, revenue in certain circumstances, amortization expense, I mean, interest expense, those are all areas where substantive analytics could be very helpful. As you think about significant risks, as you pointed out and as Christine did, generally wouldn't be sufficient relative to addressing a significant risk. And I guess with respect to fraud risk, I would just say, obviously you'd want to think about the specific fraud risk, and a substantive analytic might help you identify or further hone in on a fraud risk, or even identify something that causes you to want to perform incremental procedures. But I think it's important to have caution around reliance on a substantive analytic solely to address a fraud risk, which would be a significant risk, because for the very reason that you're setting an expectation that in fact, management's fraud might actually be to, whether it be to record revenue, for example, at the level of the expectation you're setting. So it may not be very good at detecting necessarily whether fraud has occurred. So I do think caution is important relative to continued caution, as we have in today's standards, is important relative to fraud risks. Notwithstanding that, and I think we'll get into this in some of the later questions, I do think with the emergence of better use of data and technology, regression analysis, and the combination of substantive analytics with other types of procedures, or in combination with a broader audit approach, they can be extremely powerful, and probably much more powerful than they were years ago in terms of the way in which we can execute them, the level of evidence we can obtain as a result of performing the procedures, and then ultimately, therefore, a more effective and efficient, response to risk. So we'll probably get into that, I guess, in some of the later questions. But that at least around fraud risk is what I want to add.
Thank you, Brian. Sarah Lord.
Thank you. And just adding on to that, to Brian's comments as well, I think SAPs it's a hard term. So we don't usually call it that, but SAPs are widely used not only as a response, but also to tailor the response. So when you're looking at a fraud risk, you might take that large data set And so think of journal entry testing. Run the whole general ledger through. You can do a lot of analytics to try to identify which items you might want to look at for fraud, to try to make some of those connections for you. And another area where they could be, actually are probably more effective than tests of details is where you have that large dollar or large population of low dollar value items. So you have revenue from an entity that has a very simple, maybe it's a distributor or maybe it's a restaurant, something where it's a very simple revenue recognition model, thousands, millions of transactions. Each individually by themselves, if you pull the detailed test it, there's not a lot to do with that detailed test, but doing lots of trend analysis, looking at the data holistically can provide significant audit evidence that really helps respond to the fraud risks that have been identified. Thank you.
Thank you, Sarah. Josh Jones?
Hey, thanks, Jessica. Yeah, I mean, I guess maybe just going back quickly to the other questions as well. I mean, as it relates to preparers, I think we have seen, periodically companies use analytical procedures as part of their monitoring kind of controls, whether that be doing their own analytics to kind of look at things like, percentages of commissions relative to expectations and things like that. So I do think we see them with, in some situations as a kind of an integral part of a company's overall kind of internal control system for themselves to help monitor whether results seem to make sense. But in addition, I think maybe building on something that Sarah and Brian mentioned around the use of regression. I mean, as we'll talk about probably throughout the discussion today, the notion of using expectations is a pretty integral part to leveraging any type of analytical technique. Although in some cases, with the use of data and technology, sometimes you can something called things like exploratory kind of analytics, where you go look at something like a regression to look for things that are outliers that you may not necessarily have appreciated kind of going in. And so as the PCAOB thinks about, kind of its standards associated with analytical procedures, when you think about an expectation, it could be, kind of upfront, or maybe something that is observed through the performance of analysis, and maybe looking for ways to highlight that those can both fit into kind of the concept of expectations or inform, kind of the amount of evidence you get from it would be something that would be helpful, I think, to think about as well.
Thank you, Josh. Christina? I can come back. David Fabricant?
Yeah, hi, thanks, Jessica. Maybe Josh, building on what you said a little bit, just, as a preparer, we certainly use analytical procedures every single month as we're kind of closing out and looking at certain key accounts, revenue accounts, accruals, reserves. There are a tremendous amount of empirical data that we can get to try to complement what we're seeing in those accounts as we're closing out. But I would caution everyone to say I think that those can also be flawed, especially if you're using historical trends, historical data points as part of your analytical confirmation of what you're seeing in the current period. And if things have always been wrong, even by a small amount, then you're going to predict them and you're going to expect them to be wrong using those analytical procedures in the current period. And so I see them as a complement to the test of details, but I would probably put the test of details on a much more higher level of importance than analytical. I think, they certainly can complement it. They can't replace it. Thank you.
Thank you, David. Christina?
Sorry about that. I have a question regarding the use of technology in terms of making at some point, when 100% testing became more of a norm. So at what point the substantive analytic procedures and the test of detail will no longer be really different? There won't be that distinction. And then the second question I have regarding that is, right now, the way that audit is done, even with the substantive analytic, is very deterministic. So you develop an expectation, did it meet or not? With the use of technology and the coverage become like 100% or close, it's gonna be more probabilistic. So I just want to get your view on at what point that and what kind of guidance would be helpful, and at what point given the movement of the technology, that those distinctions wouldn't be relevant anymore.
Thanks, Christina. John Bendel?
Yeah, I'll hit on this quick because I'd raised my hand, and then a couple comments were made on the preparer side because I realized you didn't get an answer to that question. I mean, we primarily use substantive analyticals, and we do develop an expectation. We use it over a wide range of revenue accounts and expense accounts, things management fee revenue and a fund complex, advice revenue, compensation, interest expense, amortization, and we do, think about that with an expectation to try to make it as precise as possible, but we think of that in a monitoring control sense. We have a whole lot of control activities that underpin, all those processes, and we view this as kind of stepping back, looking at the forest from the trees and making sure that everything is consistent, but we don't use them in place of the control activities that sit underneath, all those aspects. So that's really their purpose, from our perspective. I think probably similar to what you've heard from some of the firms and how they think of it as complementary in certain cases where there's high risk.
Thank you, John. Preeti?
So just a quick summary of a couple of things I saw from looking at some of the research findings. One, which is probably is an obvious point, is that the SAPs are not super useful if we have weak internal controls, right? So it has to be conditioned on making sure the information we're getting in the first place is pretty reliable. Second point I saw in the research is that there's different ways to use the SAPs. You can use them as descriptive analysis or predictive and prescriptive. And as you move away from descriptive, then there seems to be this issue of needing more supervision on kind of the execution of the models and so forth, in order to make sure that the deviations are properly examined. And a third point that I saw in the literature was emphasis, and this was, I think, mentioned by other people already, that there's an emphasis on developing proper expectations before you actually execute it, that the research found that that is, the best practices in terms of getting an outcome. And then a final point that I had is, it's kind of more of a question to the practitioners. I've heard people talk about using SAPs a lot in the closing process of the audit or kind of as a wrap up, but it seems like it could be really useful as a planning tool. I'm not sure how much it is used as a planning tool, and maybe that if it's not, that might be an area to direct people to kind of consider it more as the technology becomes more accessible.
Thanks, Preeti. Sarah?
Thank you. I just wanted to respond to Christina's question because I think it's a really important one. Back in May of 2020, the Auditing Standards Board issued a new standard on audit evidence. And as we were going through the deliberation period on that, one of the things we really focused on was helping to ensure that you're looking at audit evidence for the sake of evidence, and maybe less importantly for what kind of evidence is it? Is it an analytic? Is it a test of details? And in the existing PCAOB standards, there are areas that it's hardwired, that, and as well as in gas, right? In all of the standards that it's hardwired, you must do tests of details in certain circumstances. And I think your point is really well made that as technology advances and as we look at what we can do with analyzing data, that line between a substantive analytical procedure, a test of details, it gets blurred, and it's probably not actually as important as the quality of the audit evidence underlying itself. So I think, not at the risk of adding anything to a completely full standard setting agenda, I think it is something that the technology working group, the data analytics working groups really can be focusing on and saying, okay, as we do this, is it most important? And I remember back for years, we would debate on, is a proof of cash, a substantive analytic procedure, test of details. It is in the audit guide. I won't share the spoiler, but even just trying to figure out how does that fit into audit standards, a lot of time and effort was spent on something where at the end of the day, does it matter? What matters is it could be a really good procedure that provides you really good evidence over what's recorded in the financial statements. And so I think I don't have a concrete answer right now to say, okay, here's the really easy way to draw that line. But I do think it's a question that's very worthy of debate and of really focusing on what constitutes evidence, and less importantly on, what bucket do we put that evidence into? So I think that's this is a really great question for us to continue to talk about.
Thank you, Sarah. Jennifer Burns.
Thanks, Jessica. To answer Pretty's question, yes, analytical procedures are used in planning, most certainly. And then going back to Christina's question, I absolutely agree with Sarah's comments. Conceptually, though, I wanted to add just the thought that when we do tests of details, by definition, you're looking at the data that's been recorded. So where substantive analytical procedures also comes in handy is we also want to know about understatement, right? Have accounts been understated? And that's where substantive analytical procedures are an additional tool that is different than the test of details that you're doing, which is driven by what's been recorded. I wanted to make that point.
Thank you, Jennifer. Donna, Sarah.
Thank you, Brian. You can put the slides back up because thank you everybody for these comments. And this might be a good time to transition to our next topic. And before I get into the questions, I just wanted to give a couple reminders. So as I mentioned in my overview, substantive analytical procedures or SAPs involve comparisons of recorded amounts or ratios developed from recorded amounts to expectations developed by the auditor. The auditor's expectation may be developed from information from external sources. So, for example, information regarding the company's industry, or from company produced information. So financial information from comparable prior periods, or as was mentioned, historical information from the company. The reliability of information used to develop the auditor's expectation affects the appropriateness of the evidence obtained from the substantive analytical procedure. And the auditor's expectation should be precise enough such that differences may indicate potential misstatements individually or when aggregated with other misstatements would be identified for the auditor to investigate. And with that background, we have 3 questions that we'd like to cover on this topic. So first, in your experience, for which audit areas, so accounts and relevant assertions, could auditors develop more precise expectations? In your experience, would developing expectations using ratios in SAPs provide evidence that is as persuasive as using amounts? And in what circumstances would this be the case? In your experience, when and for what types of accounts have expectations been able to be developed using information from external sources? When would it be more effective to develop expectations using information from an external source? And when would it be less effective? And with that, we can open it up for comments.
All right, seeing no comments. Do you want
Everybody
to go on?
might be waiting for technology.
Right. Do you want to go on to technology?
Yep, might as well. So Brian, you can bring the slides back up. So this might be a good chance to now talk about our last section, which is discussing the advancements in technology. And since AS 2305 was written, there have been advancements in both the use of technology-based tools by auditors to access and analyze data and the availability of information. Some auditors are using technology-based tools to perform SAPs in connection with auditing certain assertions. And the advancements in technology in recent years has also improved accessibility and expanded the volume of information available to companies and their auditors from traditional and newer sources. Traditional external sources of information, such as regulatory agencies and industry data providers, are increasingly making certain information more accessible. In addition, information from relatively newer, non-traditional external sources, such as web data aggregators and social media platforms, is becoming more prevalent and such information is sometimes used by auditors as audit evidence, including when designing and performing SAPs. And so we'd like your views on, in your experience, has the auditor's use of technology changed? How and when SAPs are designed and performed? If so, how? What further changes could be expected? Would the use of technology result in auditors being able to develop more precise expectations in additional audit areas, so additional accounts or assess risk? Which type of technologies would enable the auditor to develop more precise expectations, and in which areas? And what are the advantages and disadvantages of the increased availability of information and use of technology-based tools in designing and performing SAPs? And so with that, we can open it up for comments.
Brian?
Yeah, so I mean, I think, as some of us have already said, certainly there is an increasing amount of external data available from a range of sources. But I think importantly, to the point you're raising and that's implicit in your question, is not only is it the data is available and there's more data available, but the using technology allows us to consume that data and use that data in more effective and efficient ways than we might have historically, including using techniques like regression analysis, which I've mentioned earlier. And so I do think this is an area that we've seen significant progress in the ability to make use of external data. Now, obviously, it's important to understand the relevance of that data, the reliability of that data for the purposes of your use. And as you think about how you might combine techniques relative to substantive analytics with other audit procedures, depending on the nature of the risk that you're addressing. But this is an area that I think certainly my firm, and I'm sure others have invested in recent years relative to making it easier for teams to access, use, and gain audit evidence from the use of data using using tools and technology that we've developed in some cases internally and other sources. So I think this is a very rich area relative to improvement in the effectiveness of audits and contributing to ways in which auditors can obtain sufficient appropriate audit evidence.
Jim Hunt?
Yeah, I would say add from the audit committee's perspective that across many audit committees that I'm personally involved with, you can't pick up an engagement letter anymore without very significant considerations by the audit firm of what they're doing from a audit technology perspective. And it is comforting to the audit committee for the quality of the audit, both from the perspective of the deeper analytics that can be done and the broader swath of substantive testing across entire populations that can be done. It's very rare for audit committees, in my experience at least, to talk at the specific testing level. What testing are you going to be doing, unless there's a real issue? But when we read those in the engagement letters, there does bring a sense of greater quality, higher level of coverage, and therefore greater comfort that comes about from it. So I just add that for your consideration. Thank you.
Thank you. I don't see any other questions or comments at this time.
Okay, Donna and Sarah, thank you very much for that. So that brings us to the end of our planned day. Thank you everyone for the great discussion and to members for the contributions throughout the day. I do usually like to recap some of what we heard throughout the day, but you've made that absolutely too challenging. There were just so many thoughtful views and ideas that I think I'll wait for the transcript, and rest assured that our teams will digest the transcript so that we can really deeply reflect on your commentary today. And thank you for the obvious preparation that you all put into this meeting. I am very excited to announce that we are planning for an in-person meeting in June. It will be a hybrid meeting with a remote option in case you're unable to travel or something comes up. We'll be in touch soon with more details. And with that, I'd like to thank the public who has observed the meeting. And I want to wrap up the public meeting and thank everyone for the input. I'd also like to take a moment to thank some of my PCAOB colleagues who worked very hard behind the scenes to make today possible. From the Office of the Chief Auditor, Jessica Watts, Danny Verbeck, and Akiko Upchurch, along with all of our presenters, and thank you to my colleagues from OERA, Michael Gerbit, Wei Shi, and Carrie Von Bose. From the Office of External Affairs, I would like to thank Kent Bonham, Todd Cranford, Randy Boykin, Andrew Gillies, Brian Goodnaw, Will Grofick, and Meredith Mall, and last but not least, Mai Moselle from our Office of Data Security and Technology for the technical support she provides. That now concludes the public portion of our meeting. As mentioned earlier, it would be appreciated if advisory group members can stay on for a brief administrative session. Board members, you're certainly welcome to stay, but don't feel that you have to. And PCAOB presenters and observers, thank you. You're also free to drop off from the call. And with that, Brian, can you take us back into a practice session?